All right.
Okay.
This is from Hybrid Financial Consultants, and we'll go through the whole topic of investment appraisal from the very basics up to all advanced situations. Actually, let me list everything that we'll go through before before proceeding with anything. Actually, investment appraisal has a lot of things to offer. So basically, we'll deal with quantitative techniques of dealing with investment appraisal. At first, covering the investment appraisal methods like accounting rate of return, accounting rate of return, yes, accounting rate of return like this, and then we'll go to payback period method of investment appraisal. We'll go to discounted payback period, and then we'll proceed with NPV, or which is usually shortened as net present value. Net present value. Yeah, and last I'll deal with IRR, which we call internal rate of return. So it's just the rate of return like this, internal rate of return. So this is what we're just going to deal with, just like this. And then after this method, we just proceed with actual advanced investment appraisal methods, how to compute cash flows. At first, we'll presume to have the cash flows ready, and so just go to number crunching of these methods. But after that, we'll just go further to look at things called sensitivity analysis. Then after sensitivity analysis, we'll do capital rationing. Rationing, actually investment appraisal has a lot of applications, not just this one. There is buy all these decisions, by all this decision. There is something like called asset replacement. So look at a lot of applications of investment appraisal. Actual investment appraisal is a very detailed topic. So take a look at all that. But at first, let's just proceed with normal situations. So simply speaking, capital budgeting is a whole process through which an organization generates, evaluates, and selects various capital investment proposals. You can have a lot of investment proposals, and then you try to appraise them. You try to check whether they are viable, whether if you just undertake them, you'll end up adding value to the organization. So the all methods we have been talking about are methods which are believed to create value to an organization if certain conditions are met. So this is all about capital budgeting or investment appraisal. Actually, capital budgeting is a broader term. You know, by investment appraisal, you can just take for an investment, whether it's viable or not, but capital budgeting involves the whole process, the process of allocating funds and all that. So, simply speaking, methods of investment appraisal actually will deal with methods of two types. First, we'll deal with non-discounted cash flow methods, and then we'll deal with discounted cash flow methods. Actually, there are methods which will not be using cash flows, and there are those which will be using cash flows. So just by starting, investment appraisal actually involves some steps which a company must undertake in order to perform the appraisal. So first of all, we have initial evaluation. What do we mean by initial evaluation? By initial evaluation, just like we were told that before starting a project, a decision to evaluate the technical feasibility and the commercial viability should be taken. First of all, you try to check whether there is a chance that this project will add value to an organization. If not, you can just discard it. But if there is a chance, and then you proceed with the steps. And mostly, you usually try to check whether the objectives of the company and actually the achievements of such a project are in line, whether they are in line, because if they are not in line, it will be difficult to monitor such a project. And then we come to detailed assessment. What do we mean by detailed assessment? Let's just finish up here, and then I think I should restart the computer because I'm just facing a bit of problems here. I usually highlight. So we have detailed assessment. What of this detailed assessment now? Now, by detailed assessment, after having performed an initial evaluation, the company should consider whether the cash flows from the project would add any economic value. Just as I told you, would the cash flows add the value to an organization or not? So to know whether it will add value or not, you actually have to check for the cost and benefits of the project, and then check the net value, whether there is a net positive value or not. But actually about this, we have a lot of methods to check the methods. So actually this stage involves a lot of things. Like here we are told that the method involves performing sensitivity analysis and analyzing the available sources of finance. By sensitivity analysis, we just mean that you can have invested, you can have planned to invest in a project and see that maybe it gives you a net present value of $100 million. But so, just imagine what would happen in case the selling price falls. Let's say the selling price falls by 5%. You may find that if the selling price falls by just 5%, the investment will come from giving you a net present value of 100 million to a negative value of 2 million. Total loss of value. So by sensitivity analysis, we just try to analyze the impact of one variable each at a time on the overall result of the value of an organization in case that variable changes. That is sensitivity analysis. And actually, I will actually try to determine sensitivity analysis of several variables. But for now, it's too early. It's too early. So we could just proceed with the normal situations here. So number 3, we are told we have another thing to do, number 3, which is management approval. So after having performed the detailed assessment, management will have to approve this. So it will be taken to management. Management will check and look at its impact on the cash flow of the company. And if it seems well, it is allowed. And so you can proceed with other stages. So this is what management will check. Maybe if there has been a detailed evaluation has been carried out, maybe if the project conforms to the organization's long-term strategy. Actually, in the company undertakes a project, the project should usually be in line with the organizations of the company, not just any project will be done by the company. So if it's just that way, you can proceed with the rest of the stages. So we go here, after management approval, then the project will be ready for implementation. So you go directly to implementation stage. So if about materials will be purchased, labor will be sourced, and then the job will start actually. Simply speaking, the deployment of resources will have to start in order to start the project and accomplish it. When dealing with investment appraisal, we usually try to speak of capital projects. Projects will take a lot of time, maybe more than 1 year. That's what we deal with here. And so after project implementation, we'll be monitoring the project. As I've told you, the project will be taking place for more than 1 year, most probably. And so it will need continuous monitoring. So say projects involving capital expenditure, actually maybe at the start of year 1, at the end of year 1, you can just check whether the expectations are in line with what has actually been achieved. And in case that hasn't been the case, more efforts or more resources could be added. So just like that, and you have completed the monitoring of the project. And lastly, after monitoring the project, maybe each year you monitor the project will come to an end, and then we say post-completion audit. And this post-completion audit will just mean that the project actually has been completed. And so this is the final stage involved in conducting an inquiry to the benefits, costs, if there are any wastages, if there are any deviations, something like that. We'll just come and see, when speaking of investment appraisal, that means you are just speaking about the future. You are being forward-looking. You just look into the future, you make your approximations, but at the end, you will actually have carried out the work, and so you have the actual results. So comparing actual results to expectations, that's you can just check, you can just call it P2 post-completion audit, just like that. Although that thing is also done when monitoring performance, because you'll be doing it maybe on a periodic basis. Now we are just having a recap on what investment appraisal truly entails. And now I'll just go to the real methods. First of all, before going any further, you should just know one thing. We'll put our concentration here on quantitative method, on quantitative factors, but you have to know that when you truly need to perform investment appraisal, you have to check both quantitative and qualitative factor. You know, for example, I don't know, but I believe that you have already heard about something called pest analysis. Pest analysis analyzes political environment, economic environment, social environment, technology, as well as legal environment. That's pest. That's what we call. I mean, sorry, I just said pest analysis, but sometimes it's extended to be pestel. So if you just say pest, you say P political, E economic, S social, T technological. If you extend it to be pestel, the other E would be environmental, and the last one would be legal. Just like that, everything will be complete. But in our study here, we'll put our main focus on numbers, numerical methods. So, as I told you, we have two categories: non-discounted cash flow methods, which are accounting rate of return. This is just a normal thing, a common ratio, sometimes called return on capital employed or return on investment mostly. But also we have something called payback period. No, don't worry, we'll just be going at one method and then we'll be going directly to an example. So everything will be very, very fine. But also have discounted cash flow methods. Simply speaking, when told discounted cash flow method, the word discount is actually implied in the terms time value of money. You know, when you discount a cash flow, you decrease it, you take it from the future and they bring it to the present. So discounted cash flow methods actually are methods that make use of time value of money. They involve time value of money. While non-discounted cash flow methods, this one do not involve time value of money. Just like that, and that's our main concept here. So I think I just told you that non-discounted do not involve time value of money, while discounted cash flow methods involve time value of money. So these discounted cash flow methods will take a look at the same payback period, but now the cash flows are discounted. We'll take a look at net present value and then internal rate of return. They are very, very good methods, and especially net present value is the value which is the best among all. So let's start with non-discounted cash flow methods. These are just methods that do not make use of time value of money. Non-discounted cash flow methods. As I just told you, that non-discounted cash flow methods do not make use of time value of money. Time, do not consider time value of money. So cash flows of the present, cash flows at any point in time in the future are just considered to be the same. So we say time value of money, just like this. They do not consider time value of money. So I hope that one is clear. So let's proceed now. At accounting rate of return. As I told you, accounting rate of return is just a normal ratio. We just used to it return on investment, return on capital employed, just like that. So when in need of computing the accounting rate of return, we see actually there are a lot of methods. You know, this is a ratio, and ratios do not have standard. Even when speaking of financial reporting, international financial reporting standards, ratios do not have standard except just one ratio, that is earnings per share, which is explained in I-33. But here, no actually specific method, so you just choose. So as here, I just said in accounting rate of return is expected return from an investment. So when need of computing accounting rate of return, you just take average profit. Not this is profit, not cash flow. There is a huge difference between profit and cash flow. Profit and cash flow are two different things. You know, cash flows actually are a good measure of value compared to profits. So when speaking of profit and cash flow, please, you should understand this. Let me tell you, I give a nice example. You know, when you have a profit, you can say that you have subtracted this, let's say, non-cash expenses like depreciation, but you cannot have a cash flow from which you have subtracted the depreciation, because depreciation is a non-cash expense. And so through this topic, you'll encounter situations at which you will be given profits and you would have to actually to eliminate the depreciation in order to arrive at the cash flows, right? And then by eliminating depreciation, that means we'll add back depreciation to that profit. Actually, we'll see all that. So accounting rate of return, you take average profit over initial investment, or there is another way, you just take average profit over average investment, just like that. How do you obtain the average investment now? Average investment, you just take initial investment plus the scrap value. That is the final value of the investment. Let's say your investment has 5 years. You can just take initial investment plus the investment you expect at the end of 5 years and you divide by 2. That's an average investment. But also, if you need to obtain the average, you take the total profit, average profit, you take the total profit over the entire life of the project, and then you divide it by the number of years of the project, just like that. So now, we are just trying to perform investment appraisal. So let's say you have computed the ARR, accounting rate of return. Then what? You have it. Then what after computing the accounting rate of return? After having done that, you actually have to know whether the project is successful or not. How do you decide on that? We say that compare the desired rate of return from investment with the accounting rate of return and accept the proposal if accounting rate of return is greater than the desired rate of return. So it's very much obvious that if the accounting rate of return exceeds the desired rate of return, that means you have actually succeeded, and so the project should be accepted. Now that we are just going to see an example soon, but before that, let's we just take a look at the advantages and disadvantages of accounting rate of return. And then I think after that, it's better that I restart the computer if possible, because I'm experiencing some difficulties here. All right, so advantages of accounting rate of return. First of all, it is comparably simple. It's comparably simple. It's simple, but and also many people are used to it. The ratio of profits. It's just a common ratio. Return on investment, return on capital employed. It's just a normal thing on interpretation of financial statements during ratio analysis. But also we're told that it can be used for comparison of multiple investment proposals. The accounting rate of return comes as a percentage. It comes as a relative measure. You should distinguish between two things. We have an absolute measure, but also you have a relative measure. Now, accounting rate of return is a relative measure. It compares the profit to the investment. It can seem that you have earned a profit of $100 million, but with the investment of $1,000 million. But someone can earn a profit of $80,000 using a little profit or a little investment of say $200 million. So that's why we say that it can be used for comparison of multiple investment proposals. Simply speaking, it gives results in relative terms. And then let's go to disadvantages of accounting rate of return. First of all, accounting rate of return is a non-discounted cash flow method, meaning that it ignores time value of money. This is a huge disadvantage when dealing with non-discounted cash flow methods. Just presume that the profit of $5,000 today is just the same as the one in 3 years' time, which is actually not making any sense in reality. Also, we are told here that it can also be calculated as an average. Simply speaking, it has no specific formula. As you saw above, we said you can use the formula average profit over initial investment or average profit over average investment, just like that, and you can proceed. So this is among the disadvantages. Someone could have used a different formula. But also, we are told here that it ignores cash flows, which can be extremely important for the business and they affect investment decisions. It ignores cash flows. The method said that it uses profits. By using profit and ignoring cash flows, you lack a lot of information. Cash flow is the good measure or the better measure of value compared to profit. So that's a great disadvantage. But also you could say that, profit can easily be manipulated. That's another disadvantage. profit can easily be manipulated. And that being the case, actually, you will encounter problems when using accounting rate of return. Someone can have decided to, let's say, to charge a much more depreciation than what should actually be charged, or a much less depreciation than what should actually have been charged. So you find things like that. Now up to here, this is the second method, but let's just go to an example before going back to payback period. Let me go to an example. Let me try to scroll down and you see an example here. Example, this is discounted payback period. This is IRR. Let's just go to this example. You know, something has just come up. This PC has been a bit of mess. I didn't restart it. Oh, this is page number. Let's just proceed here. I think I'm almost there. Capital rationing. And then we have capital rationing and the asset replacement and abandonment. Equivalent annual cost. Actual path through all these. So just be right, yeah, here we are. So this is nice. We are at our example. So let's just read this example and try to look at how we can solve it. So we are told XYZ company is looking to invest in some new machinery to replace its current malfunctioning one. The new machine, which costs 600 million TZS, this is just a currency, so no issue, it will be dollars, anything, euros, anything, would increase annual revenue by 165 million and annual expenses by 50 million. So this is the impact of the new machine. It would increase revenue by 165 million and expenses by 50 million, excluding depreciation. So you are told that these annual expenses are exclusive of depreciation. If you are told in the question that they are exclusive of depreciation, this actually tells you that these are cash flows because depreciation hasn't been deducted. And so we're told the machine is estimated to have a useful life of 8 years and a salvage value of 40 million TZS. So salvage value, the other name we call it residual value. Required now, determine the accounting rate of return and state whether the investment is worthwhile if the required rate of return is 15%. So actually there are a lot of methods, but actually the preferred method, the method we most preferred is to use average profit per period of our average investment rather than using initial investment. So just start like that. Initial cost we have been told is 600 million here. We have annual revenue per year. Actually, it's annual revenue already, 165 million. Annual expenses 50 million, and salvage value, we have it. Now you understand these are cash flows because we are told they are exclusive of depreciation. So you have to compute the profit. To obtain profit, you take cash flows and you less depreciation. Now you just have to understand one thing. You can compute depreciation. How do you obtain depreciation? I hope you know the ways of computing depreciation. We usually use the straight line method. How do you use straight line method? You just take the cost minus scrap value or salvage value over useful life of the asset. So your cost is 600 million, scrap value 40 million divided by 8, and you have 70 million. So this is your actual depreciation per year. So let's compute the average profit per year. Average profit will be simple because you already have revenue. You know, profit is revenue minus cost. This is revenue per annum. We are told there is 50 million of cost per annum, but it was exclusive of depreciation. So we less that depreciation of 70 million and the remaining 45 million. So 45 million is our average profit per annum. So after just having average profit, you only need now the average investment. Now, how do you obtain the average investment? So to obtain the average investment, we are just told that average investment is initial investment plus final value, which is the scrap value, divided by 2. And you will arrive at the average investment, right? So if that is the case, we just take our initial investment, which is 6 million plus 40 million, which is the scrap value, and then you divide it by 2, arriving at 320 million. So this is actually what will be your average investment, and you just need to complete the calculations of IRR, as you say that accounting rate of return equals to average profit over initial investment. And what is the average profit? The average profit, you have obtained it is 45 million, and the average investment equals to 320 million. So I think we are ready to compute the accounting rate of return. So 45 million over 320 million, and you would arrive at your accounting rate of return. So just after obtaining that, you could proceed with the question, which requires us to, we are told that determine the accounting rate of return and state whether the investment is worthwhile if the required rate of return is 15%. Now see, we have already obtained the accounting rate of return is 14.06%. So all you need to do is just to compare it with the required rate of return, and